Section 1, Understanding Hedge Funds, Strategies and Techniques for Advanced Investing. 1.1 Definition and Characteristics, Definition and Structure of Hedge Funds. A hedge fund is a type of investment fund that pools capital from accredited investors or institutional investors and uses various investment strategies to generate high returns. Hedge funds are typically open only to wealthy individuals and institutional investors due to their high minimum investment requirements. The structure of a hedge fund is characterized by several key elements. Fund manager. A hedge fund is managed by a professional investment manager or a team of managers who make investment decisions and execute the fund strategy. The fund manager is responsible for developing investment strategies, selecting securities or assets, and managing the overall portfolio. Limited partnership. Hedge funds are commonly structured as limited partnerships. The general partner is typically the investment manager or management company, and limited partners are the investors who provide the capital. The general partner has the responsibility for managing the fund's operations, while limited partners contribute capital and have limited liability. Performance fees. Hedge funds often charge performance-based fees, known as carried interest, in addition to management fees. These fees are typically a percentage of the fund's profits and serve as an incentive for the fund manager to generate positive returns. The specific fee structure varies among hedge funds but is typically higher than traditional investment funds. Investment strategies. Hedge funds employ a wide range of investment strategies, aiming to generate absolute returns regardless of market conditions. Common strategies include long/short equity, global macro, event-driven, distressed securities, merger arbitrage, and quantitative trading. Hedge funds can invest in various asset classes, such as stocks, bonds, commodities, currencies, derivatives, and alternative investments. Flexibility in leverage. Hedge funds have more flexibility compared to traditional investment vehicles, such as mutual funds. They can employ leverage, borrowed money, to amplify returns. Use complex derivatives, engage in short selling, and take positions in illiquid assets. This flexibility allows hedge funds to pursue potentially higher returns but also exposes them to greater risks. It's important to note that the definition and structure of hedge funds may vary based on legal and regulatory requirements in different jurisdictions. Additionally, hedge funds are subject to specific regulations and oversight, depending on the country in which they operate. Differentiating hedge funds from traditional investment vehicles. Hedge funds differ from traditional investment vehicles in several key aspects. Here are some of the main differentiating factors. Investor eligibility. Hedge funds typically have high minimum investment requirements and are open only to accredited investors or institutional investors. In contrast, traditional investment vehicles like mutual funds are available to a broader range of retail investors. Investment strategies. Hedge funds employ a wider range of investment strategies compared to traditional investment vehicles. While mutual funds often follow long-only strategies, hedge funds have the flexibility to engage in short selling, use leverage, and employ complex derivatives. Hedge funds aim to generate absolute returns regardless of market conditions, whereas traditional investment vehicles often focus on relative returns or tracking specific benchmarks. Performance fees. Hedge funds commonly charge performance-based fees in addition to management fees, known as carried interest. These fees are typically a percentage of the fund's profits and provide an incentive for the fund manager to generate high returns. Traditional investment vehicles, such as mutual funds, generally charge only management fees based on the fund's assets under management. Regulation and oversight. Hedge funds typically face less regulatory oversight compared to traditional investment vehicles. Mutual funds, for example, are subject to stricter regulations aimed at protecting retail investors. Hedge funds often operate under exemptions or regulations that allow them to pursue more aggressive strategies and target sophisticated investors who are presumed to have a higher level of investment knowledge. Liquidity and lock-up periods. Hedge funds may have specific liquidity terms and lock-up periods that restrict investors' ability to redeem their investments. This means that investors may face limitations on when and how they can withdraw their funds. Traditional investment vehicles, such as mutual funds, generally provide more frequent redemption opportunities and have less restrictive liquidity terms. Transparency. Hedge funds often have a higher degree of opacity compared to traditional investment vehicles. Hedge fund managers are not required to disclose their holdings and strategies publicly, whereas mutual funds are obligated to provide regular reports and disclose their portfolios to investors. It's important to note that while these are general differences, there can be variations among different hedge funds and traditional investment vehicles. The specific characteristics and regulations can vary based on jurisdiction and the specific structure of the investment vehicle, regulatory framework and investor eligibility. The regulatory framework and investor eligibility for hedge funds vary across different jurisdictions. Here are some general points to consider. Accredited investors. Hedge funds typically require investors to meet certain eligibility criteria, such as being accredited investors. Accredited investors are individuals or entities that meet specific income or net worth thresholds, as defined by securities regulators. These thresholds are usually higher than those for retail investors and are intended to ensure that investors have a certain level of financial sophistication and risk tolerance. Regulatory oversight. Hedge funds are subject to regulatory oversight, but the extent and nature of regulation can differ across jurisdictions. Regulatory bodies such as the Securities and Exchange Commission, SEC, in the United States or the Financial Conduct Authority, FCA, in the United Kingdom may have specific requirements and guidelines for hedge funds operating within their jurisdiction. These regulations may cover areas such as disclosure, reporting, investor protection, and anti-money laundering measures. Private placement. Hedge funds often rely on exemptions from public offering requirements and operate as private placements. This means that they are not available to the general public and are limited to a specific group of investors, such as accredited investors or qualified purchasers. The rules and requirements for private placements can vary depending on the jurisdiction. Fund structures. Hedge funds commonly adopt structures such as limited partnerships or limited liability companies, LLCs, to operate. These structures provide flexibility in terms of governance, profit sharing, and liability protection for the fund manager and investors. Disclosure requirements. Hedge funds generally have fewer disclosure requirements compared to traditional investment vehicles like mutual funds. While mutual funds are required to disclose their holdings, strategies, and financial information to the public, hedge funds often provide limited information to investors and regulators. However, hedge funds may need to provide more detailed information to regulatory bodies or potential investors during the due diligence process. Investment restrictions. Some jurisdictions impose restrictions on the types of investments hedge funds can make. For example, certain countries may limit or prohibit investments in certain industries or asset classes. Regulations may also govern the use of leverage, short selling, and derivatives by hedge funds. It's important to consult the specific laws and regulations of the jurisdiction in question to understand the precise regulatory framework and investor eligibility requirements for hedge funds in that particular location. 1.2 Hedge fund strategies. Overview of hedge fund investment strategies. Hedge funds employ a wide range of investment strategies to generate returns. These strategies can vary in terms of their focus, risk profile, and investment approach. Here is an overview of some common hedge fund investment strategies. Long/short equity. This strategy involves taking long positions in undervalued securities expected to rise in value while simultaneously shorting overvalued securities expected to decline. The aim is to generate returns from both the upward and downward movements in the market. Global macro. Global macro funds take positions in various asset classes, including stocks, bonds, currencies, and commodities, based on macroeconomic trends and geopolitical factors. Fund managers analyze global economic indicators to identify investment opportunities and take positions accordingly. Event-driven. Event-driven strategies involve capitalizing on specific corporate events or situations that can impact the value of a company's securities. These events can include mergers and acquisitions, bankruptcies, restructurings, spin-offs, and other corporate actions. Fund managers aim to generate returns by anticipating and exploiting price discrepancies resulting from these events. Distressed securities. Distressed securities strategies focus on investing in the debt or equity of companies facing financial distress or undergoing bankruptcy. Fund managers analyze distressed companies to identify opportunities where they believe the market has mispriced the securities, with the expectation of profiting from their recovery. Merger arbitrage. Merger arbitrage strategies involve taking positions in companies involved in mergers, acquisitions, or other corporate transactions. The fund aims to capture the price spread between the target company's stock price and the acquisition price. This strategy seeks to profit from the successful completion of the deal. Quantitative trading. Quantitative or systematic hedge funds use computer-based models and algorithms to analyze vast amounts of data and identify trading opportunities. These models generate buy and sell signals based on statistical, mathematical, and quantitative techniques. Quantitative funds typically have a high level of automation and rely on short-term market inefficiencies. Multi-strategy hedge funds employ a combination of various investment strategies. These funds have the flexibility to allocate capital across different strategies based on market conditions and the fund manager's assessment of risk and return opportunities. Long only. While not as common among hedge funds, some funds follow a long-only strategy similar to traditional investment funds. These funds focus on selecting long positions in securities expected to appreciate in value over time. Without engaging in short selling or leverage, it's important to note that hedge funds can also create customized or hybrid strategies that combine elements of multiple strategies to suit their investment objectives. Additionally, within each strategy, individual fund managers may employ their unique variations and approaches. The choice of strategy depends on the fund manager's expertise, market conditions, and the fund's investment objectives. Long/short equity, global macro, event-driven, and arbitrage strategies. Here's a closer look at the long/short equity, global macro, event-driven, and arbitrage strategies commonly employed by hedge funds. Long/short equity, objective. This strategy involves simultaneously taking long positions, buying, in securities expected to rise in value and short positions, selling borrowed shares, in securities expected to decline in value. Approach. Fund managers conduct in-depth fundamental analysis to identify undervalued and overvalued securities. Long positions aim to capture potential gains from rising prices, while short positions aim to profit from falling prices. Risk profile. The strategy seeks to generate returns regardless of market direction. However, it is exposed to market risk, and the success depends on the fund manager's stock selection and ability to manage the long and short exposures effectively. Global macro, objective. Global macro funds take positions across various asset classes, stocks, bonds, currencies, commodities, based on macroeconomic trends and events. Approach. Fund managers analyze macroeconomic indicators, such as interest rates, GDP growth, inflation, and geopolitical factors, to identify investment opportunities. They make directional bets on countries, currencies, and asset classes based on their assessment of global economic trends. Risk profile. The strategy is subject to macroeconomic risks and geopolitical events that can impact global markets. Success depends on the fund manager's ability to accurately predict and capitalize on macroeconomic shifts. Event-driven, objective. Event-driven strategies capitalize on corporate events or situations that can affect a company's securities. Approach. Fund managers focus on events like mergers and acquisitions, bankruptcies, restructurings, and spin-offs. They analyze the specific event's impact on the company's securities and seek to profit from pricing discrepancies or mispricings resulting from these events. Risk profile. The strategy is subject to event-specific risks and uncertainties. Success depends on the fund manager's ability to accurately analyze events, anticipate outcomes, and assess the potential impact on securities. Arbitrage, objective. Arbitrage strategies aim to profit from pricing inefficiencies between related securities or markets. Approach. There are various types of arbitrage strategies, including merger arbitrage, convertible arbitrage, statistical arbitrage, and fixed income arbitrage. These strategies involve taking offsetting positions in related securities to capture price discrepancies or spreads. Risk profile. Arbitrage strategies typically aim to be market neutral, meaning they seek to hedge out broader market risk. Success depends on the fund manager's ability to identify and exploit pricing anomalies while managing execution and liquidity risks. It's important to note that these strategies represent broad categories, and individual hedge funds may employ variations or combinations of these strategies based on their specific investment approach and market conditions. The success of each strategy depends on the fund manager's skill in identifying opportunities and managing associated risks. Relative value, distressed debt. and quantitative strategies. Here's an overview of relative value. Distressed debt and quantitative strategies commonly used by hedge funds. Relative value, objective. Relative value strategies seek to identify and exploit price discrepancies or mispricings between related securities or assets. Approach. Fund managers analyze the relative value of different securities within the same asset class or across related asset classes. They aim to take long and short positions to capitalize on the perceived pricing inefficiencies. Examples include pairs trading, where the fund simultaneously takes long and short positions in two correlated securities, or fixed income relative value, where the fund exploits yield spreads between different bonds. Risk profile. Relative value strategies often aim to be market neutral or have low exposure to broader market movements. Success depends on the fund manager's ability to accurately identify and capture relative pricing disparities while managing risk factors specific to the strategy. Distressed debt, objective. Distressed debt strategies focus on investing in the debt of companies that are experiencing financial distress or are undergoing bankruptcy proceedings. Approach. Fund managers analyze distressed companies' financial situations and evaluate the potential for recovery or restructuring. They invest in the distressed debt at discounted prices with the expectation of profiting from the company's eventual recovery or from participating in the restructuring process. Risk profile. Distressed debt strategies are exposed to the credit risk of financially troubled companies. Success depends on the fund manager's ability to assess the distressed company's recovery prospects, negotiate favorable terms during the restructuring process, and manage the risks associated with distressed investments. Quantitative, objective. Quantitative strategies, also known as systematic strategies, utilize computer-based models and algorithms to analyze data and make investment decisions. Approach. Fund managers develop and implement mathematical models and algorithms that identify patterns, trends, and statistical anomalies in various markets. These models generate buy and sell signals, often executed with minimal human intervention. Quantitative strategies may involve high-frequency trading, statistical arbitrage, trend following, or other systematic approaches. Risk profile. Quantitative strategies aim to exploit short-term market inefficiencies and are often designed to be market neutral or have low exposure to broader market movements. Success depends on the effectiveness and robustness of the quantitative models, accurate data analysis, and efficient execution. It's important to note that the success of these strategies depends on the fund manager's expertise, the quality of data and models used, and the ability to adapt to changing market conditions. Hedge funds may also combine multiple strategies or employ variations within each strategy to suit their investment objectives and market opportunities.